But again, a lot of this class is not going to be based on knowing how to do the calculations. If the calculations are things that you really enjoy, and you enjoy things like spreadsheets, then you may want to consider applying for the financial analyst position when we have our job fair in the second quarter. If you do not really enjoy these calculations and the formulas kind of give you hives and you don't like spreadsheets, then I would say don't apply for the financial analyst position unless you want to take this as an opportunity to like familiarize yourself with these things and get more practice at something that you found difficult. So that's up to you. But periodically, it is important for us to just calculate some of the dollar values that we're actually talking about. Okay, the formula that we're going to be using is one that we've used before in this class, which is A pert. A equals P times E to the and I've got the R down too far too. I'm saying it right, but I'm writing it wrong. A equals P times E to the RT.
The amount equals principal times E to the rate times time. Right?
Yeah. Times E is the natural base
It's the natural
to the rate times time. When we say principal, is this like the leader of the school?
Yes. Yes. We're multiplying Miss Johnson.
Yeah, we're multiplying MJ by the natural base to the rate times time. No, so this is the starting amount.
Shouldn't it be LE instead of AL then?
It's not, because it's not like an ethical principle.
Okay.
It is here, this is principal, meaning first.
Okay.
Yes. So principal is the head of the school. It's the first person at the school. Here, principal is the first amount of money. It's the starting amount of money. Yes. Whereas the principal, PLE, is sort of like is a principle. It's a code, an ethical or moral code. Okay, so this is the starting amount. So really then this is the ending amount. Okay, the natural base, this shows up in biology and physics and yeah, this is approximately 2.72. Now the rate, often the rate is given to us as a percentage, but how do we need to input it into the formula?
Decimal.
As a decimal. Okay, so this is going to be a decimal rate. And time, it can be other things, but with investments, almost always it is years. Okay, so let's go back to who remembers, either wrote it down or can go back to bank rate here's what we want. We want the federal funds rate. We want the 30-year mortgage. And we want to do this for a high credit score, and we want to do this for a low credit score.
The federal funds rate was 3%.
Yeah. Let's go back and double check that, because what happened since the last time that we had class?
They raised the rate.
Yeah, so the Federal Reserve had their meeting last week, and indeed they did raise they raised the rate by, you'll see them use the words, they raised it by 75 basis points. That is 0.75% or 0.0075. Which again seems like a small number, but we'll see why it's not. So what is the current, so what's the current federal funds rate?
It's still saying 3%.
3%? Yeah, I mean, they may have already been,
Like very just above 3%.
what does it say right now, as of today? Are you looking on the Federal Reserve website?
3.08, I think.
And is that on the Federal Reserve website?
Yeah.
What- Yeah,
That's effective Federal Reserve rate.
Yeah.
Everyone.
so 3.08%, if we wanna write this as a decimal, what do we have to do?
Multiply or divide by 100.
Divide by 100, so 0.0308. Okay, now how about if you have who can remind us what the website is that has information about sort of like prevailing commercial banking interest rates? Bankrate.com. So go ahead and have a look, and again, it's showing individual offers as opposed to an average. So we're gonna have to kind of guesstimate an average based on looking at it, that's fine. But when you're looking at a 30-year fixed rate mortgage for a high credit score, what's the rate that you are, the sort of guesstimate average rate that you're seeing looking at the website?
6.5. I think that if there's a weekly national mortgage rate trend is 6.43.
6.43?
Yeah.
Is that on the bankrate.com
Yeah.
website? Where can people
If
see
you
that?
go to the current mortgage rates, if you go to mortgage rates on the bottom left, and you scroll down below the thing that has like the weekly national mortgage rate trends.
Ooh, okay, so weekly trends, we're looking at 6.43, okay, so that's gonna be 0.0643. Okay, now you can make the adjustment, cause what it shows you default on the homepage of the website is if you have a great credit score. But if you don't, I mean, last time when we looked, if you were in the lowest credit score category, you could not get a mortgage.
Yeah.
But what's the lowest credit score range where it will give you data? 620?
But there's no 30-year ones for that.
Yeah, it's
Oh.
only
It's only 15 years.
No,
Okay.
Oh.
Yeah.
Why is it still showing up as options though? I'm only asking for.
Yeah.
Okay, so
The
I
lowest
guess we
for-
gotta go
the
up, we
lowest
gotta
for
bump
30
it up.
is 640 for 59.
And what are the rates?
It's
The lowest one on there is 5.43% for a 30. Oh wait, that's not 30.
No,
Hold on.
that's 6.485 for
Yeah.
30.
Oh, really?
Yeah.
That surprises me.
5.42.
The
Okay, I feel like
5.43
most,
is 30-year
it's the first
FHA.
number, not
So I'm
the
not sure
second.
what
FHA.
The second one
So that's subsidized by the
Yeah.
Federal Housing Authority. I mean, you've
sure.
got the government coming in to help you out on that one. Okay, this is going to be a little bit more complicated then.
It's like 6% roughly. It's like between 5.5 and 6.8.
The,
Yeah.
the
Because
lowest
the
I see
next
for
one
30 year
after
on
that is
640 is
6.875.
6.805%.
6 point, yeah, because we
That's
would,
not the average though.
Oh,
yeah, that,
sure.
The average of the first 4 available is,
Yeah, but that's 15 year.
no, all 4 of these are, I'm
Oh,
looking
wait.
at the 4.
Oh, yeah, never mind.
But
available.
like in your
The-
loan
It's
term,
6.15.
remove 15 year.
But 2 of those are FHA.
yeah, so we've got to remove the FHA loans because we've got to remove the benefit of having the government helping you out.
There's 2 for 640, which is 6.875 and 6.805.
With an average of 6.8.
Okay. So this is what I expect because to the bank, which is higher risk? Someone with a high credit score or a low credit score? Low credit score is higher risk. So you have a low score if you've had trouble paying off your bills consistently. Well, a low credit score means higher risk, and higher risk means the bank is expecting a higher return.
Which makes it so that it's harder for you to pay back.
Right.
Hence lowering your credit score further.
So we can see, I mean, some of these things end up being definite. It's a very difficult it can be very difficult to improve your credit score. Because there are a lot of these things that can become a catch-22, exactly like what you're describing. Okay. This means if the bank needs to borrow money, this is the rate that the bank can borrow money at from the Federal Reserve. This is the rate that the bank is loaning out money. Okay, so let's just do a Google search and see if we can find a reasonable website to get this information from. So not like sort of Housing Howdy Doody or something, but see if we can find a good source for it. But what is the average single family home price in the United States?
The St. Louis Fed has something about it.
Ooh. See, I know, the St. Louis Fed.
I know I don't have the right information though.
No, the St. Louis Fed is the bomb. The St. Louis Fed absolutely can be relied upon.
But it doesn't say anything about single family.
Oh, it doesn't separate it out?
I mean, there is another
Except the median sales price of existing single family homes.
Oh, okay. So rather than new homes, that works. So if you want to buy a pre-existing home as opposed to working with a developer to have a new home made, what is that, Hinka?
$396,000. Although someone should put that number back.
All right. Well, let's just go ahead for this.
It went up. It was like 420,000.
Can you
But-
see for September already? Because I can't see.
No, there's no September yet. That's August.
And what's your source, Blake?
Same
April.
thing.
Oh, okay.
I found
April was 440.
Okay.
I found the Federal Housing Price Index.
Okay.
They've got a broad measure of movement of single family house prices. Give me the data sets. Where are you? I don't know what these words are.
Okay.
I found another site that corroborates $396,300 for August.
For August. Yeah, I mean, as rates go up, the prices are going down because it becomes more expensive to borrow. Well, let's go ahead and split the difference and make it an easy number to calculate with. And we'll just go ahead and say a $400,000 home and
What did you say for September?
There's no September.
yeah, I
And
did,
it's 396, 300 for August.
yeah, I mean, September's not over yet, so they won't have the data for that yet. So we're gonna split the difference. We'll call it 400,000 for the ease of calculating it. And we're gonna, so the bank then is going, so this is gonna be, so this is loan 1, this is loan 2. Again, for the ease of calculations, we're gonna say that the buyer is taking out the full $400,000. So they're not like putting some money down up front and then paying off the remainder. We're gonna keep the numbers as simple as possible. And let's just say let's say for whatever reason today, the bank doesn't have the cash on hand, so they're gonna borrow it from the Federal Reserve at this rate. And so the bank is gonna borrow $800,000. Okay, so that's happening today. So now we need to calculate 30 years from today. And just assuming that basically these get set in stone and everybody pays everything that they're supposed to, and at 30 years from today we're totally settled up and everything is paid off. And so we need to calculate then this amount after 30 years on this 800,000 at 3.08%, this 400,000 at 6.43, and this 400,000 at 6.84%. So go ahead and apply A equals PE to the RT. Remember on your calculators, if depending on how your calculator is formatted, you may want to put parentheses around the R times T just so that your calculator isn't taking e to the r and then multiplying that by t. You want it to take e to the r times t. And then once you've got these three values, compare them to your neighbor and see if you have ended up with the same amounts. So did you have an answer or did you have a
I
question?
have an answer.
Okay,
I
so
will wait on the answer.
yeah, so wait on the answers. Go ahead and compare with your neighbors.
Okay, hang on. So for the rate, are we meant to do the 3.08% or whatever, or do we do like 103.08?
You do this R as a decimal.
Wait, you put that as a decimal?
Yeah, remember the rate has to be the decimal rate. So that's why I've rewritten all of these as a decimal.
Oh, they're
Should we
already.
be rounding to the nearest cent?
Okay.
Yes, round to the nearest cent.
If I'm right, then it will right.
That's why it's small.
And then principal is the 800K, right?
So 800, because remember the bank's borrowing this 800 in order to make these two $400,000 loans.
And it's 30 years.
And it's 30 years. In all cases, it's 30 years. No. I entered this in wrong. To do these one at a time.
Yeah.
Is this like also 400,000?
Yes, this one's also 400,000. So both of these borrowers are purchasing basically.
Oh no, that's just my first round.
Did you get this?
No. Yes. No. Oh yeah, no, I did get that. Well, not for decimals though. Yeah, there. Should I round them?
Okay.
I'll round to the.
So let's go ahead and look at this one first. How much is this bank going to have to pay? Overall, how much is this bank paying to the Federal Reserve? Yes, Inga.
$2,015,478.05.
I missed something. I thought that looked tiny. It was less than the initial. I'll
Oh.
have to look at that again.
Yes, so you want to double check how you have got it. Okay, how you've got it entered. All right, so yeah, that's about 2.5 times
Yeah.
what was initially borrowed. Okay, so this is what the bank has to pay back to the Federal Reserve. How much have they gotten from this high credit borrower? Yes, Hestia.
$2,075,$753,049.67.
All right, I'm gonna go ahead and make that 50. But thank you for rounding it to the nearest penny, because they will want every single penny. Okay, and how about borrower number 2? Yes, Blake.
$3,113,380.98.
Wow,
Okay, so
so many
381. So in total then on these two loans,
A lot.
They've made about
Almost
3
6
million.
million.
yeah.
6 million.
6 million
and
minus
then
the.
-2, so it's about 4
Yeah.
million.
Well, let's go ahead, let's be
They made
753.
3,850,952.53 in total, I think.
That seems about right.
That's
Who made 3 million?
So this
Back
is,
to that.
Yeah, there would be.
this is about
Oh, wait.
5.8 million.
It's like 5.8.
That's split up.
They have to pay 2 back.
Yeah,
So,
Oh.
3.8.
So,
385,
Oh my gosh,
Yeah.
look at this.
3,800,000.
Yeah.
Wow.
So, okay. Now, one thing that I will say, these numbers look really extreme because thankfully mortgages typically are not calculated continuously compounding.
that's nice.
Thank
So
God.
usually it's just compounding. They calculate an annual rate. So it's only compounding once a year as opposed to continuously.
Ooh, thank God.
But the thing is though, proportionally,
It's a lot of money.
bank.
you know, they are experiencing, in this case it's not like the bank has a preferential interest rate compounding system compared to the individual loan holders here. And you can see the other thing that happens is you can end up paying a lot more. You end up paying a lot more back to the bank than the original value of the asset.
The bank made about like 4 times the money they took out,
Yeah.
almost 5 times.
Yeah.
Yeah.
Okay, so this is why again I just wanted to point this out.
Capitalism, folks. It's crazy out there.
You ideally, it's like if you want the free market to work for you, if you want capitalism to work for you, you know, we're living in a system where it's very, very difficult to not participate in capital markets at all, to not participate in the financial industry at all. Most people at some point will need to take out some kind of a loan to buy a home or a car or get a college education or for some other reason. But it's important to recognize that you want to have in your mind, if you're ever in the situation where the interest rate is working against you, you want to balance it out. You want to also find a time where you're setting it up so the interest rate is working for you. Yes, Aurora?
Why can't we just borrow from like the government? Why is there this useless bank?
Why are there commercial banks as opposed to everything simply being with one centralized bank?
Yeah, that makes sense.
Uh,
It's a good question.
It would take.
I
some
mean-
out of the process.
you would have to have absolutely full faith that the government in all forms at all times was fully reliable.
But are banks reliable?
They're not, well, they're not, and, you know, periodically banks do go out of business. You know, famously in 2008, you know, Lehman Brothers went into default, which started that massive housing crisis recession. But if you have a bunch of banks, if some of them are unreliable and they're competing with each other, it's like others will survive. Whereas if from a financial perspective, we're putting all our eggs in one basket, you know, we have to have absolutely full faith.
But I mean, has the government ever failed?
Do government? Yeah, if we look at the history of the world, have governments ever failed?
No, never.
Yeah. Yeah, it's a fully, wholly reliable system. Okay. So, and again, this is, you know, this is a good illustration. Even though like these interest rates only look to be about double this one, this amount is way more than double this amount. So, paying attention to the interest rates and even small changes in the interest rates, as we can see here, going from 6.43 to 6.84 is not a huge difference, but we can see it can make a huge difference in the outcome. So paying attention to interest rates in investing turns out to be really important. Any questions about what's up on the board right now? Okay. So let's go ahead then and come back to the bonds assignment. the stuff that we've talked about that relates to personal finance applies to corporate finance and the fixed income market, bonds, debt, et cetera, et cetera. If you don't have the reading up, like I don't, I'm gonna go ahead and pull it up.
Can we close the bank rate page and all that?
No.
Yeah, you can. And this is just a reminder that if I, that's a, yeah, I was about to say,
I swear.
yeah, no, this is just a reminder if you submitted your work, but there isn't anything attached, not, not pointing any fingers. Or if you have not turned the work in, then this is just a reminder to please do that before 8 a.m. tomorrow, or your name is going to go up on the whiteboard. Ta-da. All right. So let's look at, okay, so here we go. So exhibit 1, and this is the one that you had a question for me on, Zahara.
Yeah, well, I didn't know if I did it right.
Well, let's talk about it. Okay, I'm looking. I'm seeing example 1. I'm looking for exhibit 1. Okay, here we go. Exhibit 1, which is on the book page, is 215. But let's go ahead and recreate this up on the board. So Zahara, do you mind reading off for me what the tiers are? Which number goes with each side?
Pulled it up,
Okay,
sorry.
that's okay. So this is seniority, ranking of debt securities. I think they've got this kind of going at a diagonal here.
Yeah.
So we can have like these little,
It's
these fun little,
funky little arrow.
funky little arrows. Do you have it?
It's loading.
It's loading, okay. We can phone a friend. Yes, Sasha?
Okay, so the top one is secured debt. Do you want me to like describe which ones they are on this list, or like what they do?
No, that's okay. First, we'll just go ahead and recreate this.
And then unsecured, there's a bunch of different types.
Yes, and they are,
Senior unsecured debt, and then below that is senior subordinated debt, and then below that one is junior unsubordinated debt. Oh, subordinated. Yeah, I say
oh, no,
just subordinated.
just subordinated. Okay, I don't.
I mixed up unsecured
Okay.
and subordinated.
Yes.
They're the same word.
Yeah, no, I mean, so you can imagine what these meetings start to be like when you're talking with,
So
you know,
the-
bankers and prospective, and they're like, well, the unsecured junior subordinated debt on, you know, Ravencore.
This maturity expires in the fourth quarter of the 82nd
Yeah.
year.
Yeah, so it starts sounding pretty quickly like garbledy-gook. And then let me, okay. So then we want to see, so one of the things that I will start with in this question once a loan has been made, so let's say that we have, you know, an investor who made a loan to Ravencore so that we can remodel our storefront, Ravenco. But they may decide that actually they need that cash to do something else. They can sell the loan to somebody else. So in the same way that you can buy stocks and bonds on the stock market, you can buy and sell loans on the bond market. So sometimes an investor will loan money to a company and they will hold it all the way until maturity, and the company has totally paid it back with interest. But oftentimes, once the loan has been made, that loan will then be sold to other investors. This is why the 2008 financial crisis is often referred to as a mortgage crisis. Because the bank, as soon as they were writing the mortgages, were packaging them together and then selling those bundles of loans to other investors. And they weren't necessarily writing mortgages that people would realistically have the ability to pay back, which many of them didn't, and they defaulted on their home loans. And they also didn't keep good track of the paperwork, so then they couldn't actually figure out who owned the house. Okay, so in this question though, when it's asking which will be the most expensive to buy in the secondary market, that means if this loan is being bought and sold after it has been issued. Okay, so we'll come back to you then, Sahara. Which of these, if the original loan issuer wanted to sell it and another investor wanted to buy the loan, which did you think would be the most expensive and why?
I thought that the secured debt would be the most expensive because, well, I did it in a different order, so I was like referencing because it would be the most secure and have the least amount of risk
That's right.
involved with it, so it would be therefore more valuable.
That's right. Least risk, most expensive.
Doesn't it also, since it's less risky, typically come at a slightly lower rate?
Like a coupon?
Yes, but so that's a really good point. This is why a lot of people don't like trading in the bond market.
Oh no, I won't make millions in a day and retire in my 20s.
Miserable.
Oh no.
You have no life. Go get
So
one.
let's-
I would
so-
like to retire in my 20s.
So let's say, for example, that the loan is just $100. Okay, and you're right. On the secured debt, maybe the coupon is 3%. And maybe we're just going to say all these loans are just a year. So here's the loan value. Here's the coupon. Okay. We're going to say the maturity on all of these is 1 year. So then we have the question of what's the price going to be?
It can't be any more than $100, right? Because then what's the point of buying the loan?
Well, so then let's go ahead and add that then too. So let's just go ahead and say like what the settlement is going to be. It's going to be $103. So they're going to pay the $100 back plus the 3% coupon, which we're saying that let's just say we're calculating that at the end of the year.
Yeah.
So then we have the price. Okay, so here's secured, unsecured senior. Okay, let's say that this loan was also for $100. And you're right, when this loan is issued, I mean, this is just like with the mortgages. The mortgage for the high credit score is not the same as the mortgage for the low credit score. Okay, unless it's effectively just being propped up by the government. The government is issuing insurance on it. Okay, but that's not happening here for Ravenco.
Oh no.
So here for our senior unsecured debt, what are we expecting then in terms of the coupon?
Maybe like 5%.
Yeah, let's just, okay, This debt is not secured, and so we are expecting, our investors are gonna wanna get more money back. They're taking higher risk, therefore they're expecting a higher return. So we're also gonna make this one 1 year. So this one's $105.
Well, really move out.
Okay. Senior subordinated. What do we expect the coupon on this one to be compared to the other two?
750.
Sure. So we expect it to be higher. We're also saying this is for a 1 year term, so you're gonna get $107 back. And I'm just gonna go ahead and continue the trend here.
Or we should make it 8.
Yeah, we should make it 8. Why?
I'm just keeping it consistent. So now we have this question then of price. And what somebody might buy this loan for today.
Well, you're gonna wanna charge at least $100 so that you can get your money back, right? But it has
Well,
to be less
and but
than
here's
$200
here's to Hestia's point. I mean, in theory,
These are too
If
small
we-
to be worth
well, but we can imagine though that now we just say
Yeah.
that these are millions of dollars.
Yeah.
And now all of a sudden,
Hey,
now all of a sudden now we do
Yeah.
care.
now we care.
We kept it at 100 just to keep the calculation simple. When the federal funds rate, what was the federal funds rate at the height of the pandemic? Yeah,
Yeah,
effectively it was 0. It was like 25 basis points. It was like 1/4%. If somebody really has faith in Ravenco,
I would.
and they're only, and if they were able to, the banks, if you put your money in like a CD, which we'll talk about that another time, but where you basically just if you loan your money to the bank will pay you. But obviously they're gonna pay you less than what they're gonna pay to the Federal Reserve. So in other words, if we're in the middle of the pandemic, and I basically can't get any money for saving my money in the bank, the interest that I'm getting just keeping my money at the bank is so small, I might be willing to pay as much as 102 to get this 103 payout at the end of the term, because it's more than what I get just leaving my money in cash at the bank. Okay, but today is the federal funds rate basically 0?
No.
No. So what do we think, given that the federal funds rate right now is 3%, meaning that if I save my money, I'm probably going to be able to, over the course of the year, get paid interest. Something that's moving up towards 3%. It's not there yet. The banks are being really slow. So if you have money in a savings account, they're not paying you anywhere close to 3% yet, I guarantee. But imagining that if you just keep your money in cash, you can make close to the federal funds rate of 3%. What would you be willing to pay for this today?
Maybe 100, a little less than 100.
97.
I don't know.
Yeah. Yeah, I feel like, yes, something less, to me, like 97 struck me as reasonable. Because if I pay 100, I'm only going to get the $3, which is the same if I just keep it in cash at the bank.
Yeah.
And cash at the bank, as long as you don't have more than $250,000 in cash at a single bank, it's FDIC insured. So if you have $1 million sitting in cash, You can just split that up between 4 different banks and it is insured, meaning it is impossible that you will lose your money. The government, even if the bank goes out of business, the government will make sure that you get your money. Who wants to guess when that rule was put into place? When was the FDIC created? Yes, Ari.
2008 or Great Depression.
The Great Depression. So the reason the Great Depression was so bad was when banks out of business, people totally lost their savings. Okay. Well, so then here, let's go down then to the other end. What do you think somebody might be willing to buy this junior subordinated unsecured debt at?
90.
There's a lot more risk. Okay, so let's go ahead then and calculate these returns.
Well, it's also only 1 year though.
It is also only 1 year.
Like a lot can happen in 1 year, but not that much can happen in 1 year.
What if it's
And as a matter of fact, short-term high-yield debt, so 2 years of maturity or less, has very, very, very infrequent default rates. And this is actually, again, people start looking at all these tables of all these numbers and their eyes start glazing over and they're like, oh, I'll just buy more Google stock.
No. Buy Firefox. Buy
But this is where, this is one of the areas of the market where if you're a good investment manager and you can read financial statements, this is definitely an area where you can make consistently serious money. For exactly the reason that you're talking about, Michael. But let's go ahead and then calculate what the actual rate of return is then on these two. Okay, this is $6 more than 97, so to calculate the percent return over the year, it's 6 over 97. What does that come out to as a percent?
6.18.
Okay, so this is about 6.18%. So you've made a 6% return, and that's better than cash, which maybe if you're lucky is 3%. And so you've taken on some risk, but you've made additional return. All right, let's go ahead and take a look at this guy. This is $19 over 90, so higher denominator or higher numerator, lower denominator. What's the percent return on this investment?
21.1.
Yeah, so everyone's like, oh, bonds are boring, fixed income, everything's issued in denominations of 100,000 or $1 million, boring.
Oh no.
No.
I need financial security. No.
Okay, so everyone's always, the stock market looks much more exciting, and the graphs are going up and down, and da-da-da-da-da-da-da. But actually, right. But actually, if you're looking to be a professional investor, if that's a career that you are considering, my suggestion is definitely to pay attention to all the classes on bonds and fixed income, because in this area, which is known as high yield bonds, because it has a high coupon, this is actually an area to potentially, it's riskier, so you have to be able to read financial statements and make a reasonable prediction as to whether or not a company is going to go bankrupt, and you better hope that you have a good economist on your team so that you can see those curveballs coming before they're thrown at you. But this is actually a great place to make some good money as an investor. So this was a much more in-depth answer, I believe, than what you were anticipating, Sahara. But it's a very, yeah, but it's a very, very good question. Okay, question number 2, we've got a basic vocabulary question. All of these have to do with fixed income, with loans, with debt, with bonds, but then there's like these very specific vocabulary words depending on the maturity. In other words, how much time remains until the loan comes due. So what is the order longest to shortest? Yes, Sasha. Bonds, notes, bills.
Oh, I
Would-
put it backwards. I'm
Yep.
I knew what I was doing.
Well, you can, if you need to adjust your answer right now and resubmit, you can.
Oh, thank you.
It's tricky saying longest, shortest, because shortest
Wait,
and longest.
bonds, notes, bills is
Longest to shortest, yeah.
Oh, okay.
Maybe I
So
did
it's like
accidentally
reading.
turn it into a trick question by making it longest to shortest.
I
You failed to fool me.
Ah,
Aha.
good,
huzzah.
young, yes, young
I-
grasshopper.
Huzzah. I beat
Yes.
your devilish trick.
I know. All right, so question number 3. Well, first of all, what are all of these things? And question 3.
Words.
They are all words, and they all represent what category of loans or fixed income?
I like but
Oats?
it makes me happy.
I love oats. I love oats and kiwis.
I do too. It's like breakfast,
Yeah.
exactly.
Yeah.
But what kind of bonds are these? Yes, Mateo.
Wait.
Oh, government.
On question number
bonds.
3,
Yeah.
they're good. Yes, these are the nicknames for different kinds of government bonds. Yes, sorry.
So I was a little confused about, it was talking about, like in the question and the textbook, there was a discrepancy between, like Bunds, Germany, the US, and one of the other things I wasn't sure where it was.
It would be if you have that part of the text, it might be easier to answer. Yes, Hinka.
just a quick semantic note that it's probably not gonna matter. It's not pronounced buns.
Ah.
It's not pronounced buns.
Hinka, don't ruin my fun.
It's Bunds, like the Bundestage, which is the German Congress.
Oh,
So it's not.
thank you,
they're not-
Hinka.
They're not buns.
But I really want it.
I will say I
was
work.
more humorous thinking about the
Yes.
buns.
Yeah.
Buns. I will say, working in investment offices, both in the United States and the United Kingdom, all Anglophones pronounce that incorrectly. but thank you for helping us. So indeed, and so you've given that one away, Hinka. Bunds are from Germany.
Never mind, it was just a formatting thing in my document.
Oh, gotcha. Okay. Kiwis,
New Zealand.
gilts,
Okay.
treasuries.
US?
Yeah, treasuries are the U.S.
Is it oats from this though?
Uh-uh.
It's French for
Obligation, something,
It's,
something.
It's basically treasuries
It's the
translated.
last word
Yes.
is treasury.
Oh yeah, treasury. Yes.
I read this.
I have that.
What is it with French people? and
Obligation
accents,
of-
That's a decent question. That's a decent question.
It was an actual French class. I think everyone would have.
Yeah, they don't. Yes, I have noticed more than some other places that I have visited that the French take umbrage at mispronunciation of their words. So that could be an attempt to.
Oh, they're trying to stifle it.
They
Yes.
put all those letters in that they don't
I
need.
know.
Take your letters out, friend.
No one can
Stop
pronounce it.
calling it.
Obligation I don't know how to say that one.
I'm gonna see if I can.
Du trésor.
French stupid.
Gotcha. Okay.
Obligation? Wait,
So weird.
Is that what
It's
actually
Asimabe.
a tongue twister?
Wow.
It's called
What
Asimabe.
Obligation.
what is it?
Obligation assimilable du trésor.
Yeah.
Wow. Okay. Merci. All right, so let's take a look at number 4. I want to hear from somebody I haven't heard from yet, potentially. But what in question 4? What are all these things referring to, and what's the differences between them? Yes, Kelsey.
Yeah, sorry, wait, never mind.
No,
My brain is
no, go ahead.
Alright, so first we have fixed rates, and they have both a fixed coupon rate and a fixed par value, and they don't exist forever, and all that, and you might have been able to guess by the name. My brain's not working today, so.
No, that was good. Yes.
Great.
Yep, very good.
Floating rates are the same thing, except they have the ability to, but the coupon rate is able to change, and it has this little ditty around reference rates and riskiness to calculate how it does change over time.
Yes.
And then there's inflation linked, which is specifically designed to protect its holder against inflation by adjusting the coupon rate to go along with that. And then zero coupon has no coupons, and you just, the only money that it actually offers to you is the par value that you get when it expires.
Yes.
So yeah,
Very
Which is
good.
kind of weird.
it's very
Because they
interesting.
could just, it feels like they just did, because again, it's mostly, they said like it's mostly for males. So it kind of feels like they were just, someone was just too lazy to calculate a percentage. And then just,
like, no.
Yeah.
decided to see the end now.
Zero coupon bonds are quite unusual. Yes, Hinka.
So somewhere out there in the world is a figment of human imagination entitled Inflation-Linked Unsecured Senior Subordinated Debt Security.
In theory, yes. However, I will say it's a very unusual for a corporately issued bond to have an inflation-linked coupon. That's very unusual. Traditionally, inflation-linked coupons are just issued by government agencies, in which case it would be secured. Yes. In theory, though, yes, and it may be out there. If you could think of it, it probably exists somewhere.
Somewhere in Miami.
Somewhere in the same
Somewhere in Miami.
Yes. Yeah, exactly. Somewhere in Miami. All right, this final question number 5 on calls, puts, and convertibles, we will discuss at the beginning of next class. There's not additional homework between now and then. However, if through this discussion you have adjustments that you want to make to the work that you've done and resubmit, that is totally fine. We've got a couple extra minutes here, so feel free to just hang out for 2. But that concludes our discussion for today.